What's up everybody, Nate here. So right now we are currently undergoing one of the biggest resets for our global economy and markets that we have pretty much ever seen.
Well, that's new.
Now obviously a global reset is going to have its own set of consequences, but depending on who you ask, these consequences are going to be either something that's really good or something that is terrible, sending us into a near depression. For instance, if you look at our government right now, President Joe Biden and Treasury Secretary Janet Yellen are saying that our economy here in the United States is going to be great. They're not sure what's going to happen overseas in other economies, but the United States economy is strong and so is the US dollar. However, if you ask individual investors like Jamie Dimon, they believe that the United States and the rest of the world is about to embark on one of the biggest recessions that we have seen, even bigger than the 2008 Great Recession. Not only that, but the IMF, or the International Monetary Fund, is reflecting the exact same thing. They believe that the worst is yet to come for the entire global economy and that people need to get prepared. And then you have individual banks that are fighting as well. Goldman Sachs believes that the entire United States economy and global economy is going to shrink in 2023, but Bank of America says that consumer spending and consumer investment is still really strong, so there is nothing to worry about.
That sounds good, right?
So with that being said, I kind of want to address the big elephant in the room right now. Is the entire global economy about to face a massive collapse, or are things going to end up being just fine? I'm going to kind of break down what exactly is going on right now, how you can prepare your money for the future no matter what happens, whether we see a recession or not, and what exactly we can expect to see from the global economy and markets in the future. All right, so the first thing I want to do is address Janet Yellen and President Joe Biden's thoughts here. Now, they are kind of echoing the same thing when it comes to the United States economy. They believe that the United States economy is extremely strong right now, but they're not really sure about other economies. And the reason they believe that is because the United States dollar is extremely strong. The Federal Reserve right now is raising its benchmark interest rates, and as it raises its benchmark interest rates, the key thing you need to take away is that there's going to be fewer dollars in circulation. Inflation means that there's a lot of money printed, means there's a lot of money being spent, so prices go up. But when you don't have a lot of spending and when you have a really hard time accessing money, now your currency is really strong because more people want it because there's less of them. But it's expensive to come by, so not everybody is going to be able to get it, lowering your inflation. Because the United States dollar is the reserve currency of the world, meaning that on a global scale, countries and businesses want to have it and they want to do business with it. That means that as the United States dollar gets a lot stronger, the United States economy, in theory, can remain strong. But then they're kind of worried about the entire rest of the world, right? Because as the United States dollar gets stronger, that means other currencies are going to be weaker. We're starting to see this in the UK right now with their bond crisis and a lot of their tax cuts. Now, a lot of the tax cuts that they have proposed are not actually going to become a thing anytime soon. They kind of canceled a lot of that, but the initial scare was that the new UK Prime Minister and the government was going to institute a lot of inflationary policies, and cutting taxes and printing money and taking on new debt was going to mean that inflation was going to continue to rage in the United Kingdom, and they have a really bad inflation problem too. So when you have inflation in one currency, that means investors, well, at the end of the day, they still want to make money. So where do they go? They go to a stronger currency, and the US dollar is even stronger. So investors that can't afford it are going to the US dollar as a safe haven right now, only making the US dollar stronger, but that is hurting the economy of UK and other countries. So in that sense, the US economy is going to be just fine until, of course, it isn't, because you don't want your dollar to be way too strong, because then nobody's going to be able to afford to do business in it. And if nobody can circulate US dollars around the globe or here in the United States, that means businesses are going to see a lot less profits because everything is getting more expensive and US dollars are harder to come by. People aren't going to be spending as many US dollars because there is so few of them right now. That could ultimately hurt businesses across the globe, and right now these businesses across the globe and in the United States can't really afford to get hit any harder. This kind of goes to the idea of this massive global debt problem that we have across the world. So a lot of companies, whether it's an investment bank or businesses or just startups, have a debt issue. And not only that, personal consumers also have a debt issue. We have seen debt rise in every single category you can possibly possibly imagine over the last 2 years. In 2020 and in 2021, there was a ton of money printing, not only by the Federal Reserve, but by other central banks across the world. So when you have a lot of money printing, the government is going to take this money and give it out to all of its people, right? The government doesn't just print money and then sit on it. They actually give this money out to banks and businesses and consumers. And we saw that in stimulus checks. We saw that in the mortgage moratorium program. And we saw that from the quantitative easing program on Wall Street. Not only that, but these central banks also lowered their benchmark interest rates to near 0%. So that meant even more money was going to be floating around. People could get a business loan, or investors could invest in a business, or individuals could get a mortgage or an auto loan extremely easily because they were going to be saving hundreds of thousands of dollars every single month because the interest rates for that loan were very low. So these businesses took on debt, and they took on debt, and they started to hire people, and they started to build factories, and they started to invest in real estate, and they started to invest in other companies. But now all of that money that has been borrowed, all that money comes with an adjustable interest rate. So whoever they borrowed it from, now they're going to have to start making more. But with the United States raising its interest rates and all of these businesses taking on a lot of US dollars are going to be harder to come by, and that means profits are lower. So how are these businesses going to pay their debt? Well, this is the problem that we're running into, and it's not just a business problem, it's a sovereignty problem too, because governments like the UK and in China rely on a lot of these other countries to pay their bills. But like what we're seeing in China right now, with Sri Lanka not paying its bills and actually going into bankruptcy and defaulting on its debts, now China isn't going to get any payments from Sri Lanka. If other global governments were to do the same thing, now China and other nations are going to be in a huge pickle, right? Because they're not going to get any of this money ever again. And what that ultimately leads to on a global scale is higher unemployment and a deep recession, because all of this is going to trickle down from the government level to the banks, to the businesses, and then the consumers. And consumers are the ones that drive the economy in most countries. If they're not able to spend any money because, well, they don't have a job, or things are just way too expensive for too long and they're not getting a raise anytime soon, that means that now all of these businesses are not going to have any money at all to spend, leading to them actually going into bankruptcy and completely failing. That means businesses could essentially fail in the next coming months. And the Federal Reserve in the United States knows this, right? They actually predict that unemployment here in our home country is actually going to go up to around 4.4% by the end of 2023. And that is a conservative estimate. This would mean that around 1 to 2 million jobs are about to be lost. This whole debt problem in the United States Federal Reserve raising its interest rates is a bigger problem than it even seems, because all of this debt that these countries have taken on is actually even bigger than you know. After the Great Recession of 2008, well, the Federal Reserve and other central banks actually lowered their benchmark interest rates for a very long time. Actually, in the US, rates were near 0% for around 6 to 7 years. They didn't start to even go back up a little bit until around 2015. That means these businesses exploded in growth. This is oftentimes referred to as one of the biggest booms in the United States economic history, and it has to do with really low interest rates. So these businesses hired more people, they created more factories, and like you've seen, startups boomed. Startups in the United States didn't need to make profits in order to be a sustainable business. They just needed investor liquidity, and they could get it very easily because interest rates were very low. Investors could get all of their money back by investing in a startup or another business because interest rates were low. It was basically free money. Even if they got a 2 to 3% gain on all of their money, well, that's going to be higher than the 0% that they borrowed the money at. So of course they were going to invest in businesses, and that made a lot of people and businesses and corporations very rich very quickly. Now, I made a video just a few weeks ago about Credit Suisse. Now, Credit Suisse is an investment bank that is kind of getting into a little bit of trouble right now because of a thing called credit default swaps. And if you want to watch that full video, you can do so with the link in this corner right here. But the basic gist is that Credit Suisse is taking on a ton of investment dollars right now. We're talking hundreds of billions of dollars, but they have hundreds of millions of dollars in these credit default swaps that they have to continuously pay money on. The benefit is if the people that borrowed the money from the credit default swap, like somebody taking out a mortgage or a business taking on debt from Credit Suisse, well, that means if they default, they have an insurance insurance company that gives Credit Suisse the money back. So that means Credit Suisse can continue to operate, nothing really happens. But if you see a systemic failure, which means pretty much all of the businesses fail and all of the banks fail, well, now the insurance company is not going to have hundreds of billions of dollars to fork over to Credit Suisse, which means all of those banks and all of those businesses essentially fail, including Credit Suisse, including all of the investors. But if you think about this on a smaller scale, well, think of over the last 2 years in the United States. Pretty much everybody that you know and their cousin got a house or got a car or made a huge purchase, which means they are more in debt than they ever have been. And when you have an income, if you have a way to pay back this debt, it's not really a huge problem. I mean, it's keeping you from building wealth, but it's not really a huge problem for our macro economy. But if we start to see foreclosures or auto repos start to increase, now all of these mortgage-backed securities and credit default swaps and all of these businesses that have money tied up into them, somebody has got to pay all of that debt. And if unemployment goes up and people don't have an income, now all of that debt is just sitting there unpaid. Now on to this great global reset. So in 2022, the Federal Reserve has seen inflation as a problem, and they're starting to raise their interest rates, making it harder for businesses to take on debt, making it harder for investors to invest in these companies, making it harder for consumers to get a mortgage and an auto loan. And that is designed to eliminate demand in our economy. It's not going to be as easy to take on all of this debt. It's not going to be as easy to spend your money. So all of that is being limited. This is completely different than what these companies over the last 10 to 15 years know. They know that they can get investor money very easily, but now in 2022, they cannot. So they are all completely switching over to a profit-centric model. And if they don't make a profit and if they can't pay their people, now you have huge unemployment, not just in the United States, but across the globe. And ultimately, inflation will come down, but the entire economy is going to be crashed. And what you've got to remember is over the last couple of years, investors didn't really care if you made a profit. In fact, profits were seen as a bad thing because if you have a lot of profits, think about what that means. Profits are money that is not being used for anything. They're just sitting there. It's not part of growth and it's not part of reinvesting back into your company. So these investors would rather these companies grow and grow and grow as fast as possible so they can get a bigger return on their money. So they don't want to see profits. They want to see reinvestment. It was all they know, but now everything is being reset in our economy. None of these companies are going to be able to grow as quickly anymore, but they have already grown very quickly in 2021. So now the major contraction is what we're going through right now with massive unemployment and these businesses and our economy actually starting to shrink back down to a size that makes sense in terms of profitability. We just don't know what exactly is coming next. So that means that you need to be prepared with your money no matter what comes next. Obviously, we could be facing some unprecedented pain in the future. So the first thing that you have to consider is your money management. You have to be really thoughtful with your money over the next 3 to 6 months to a year, right? Because we don't know what's coming next. If you were to make a big purchase today and you were to lose your job, well, not only is that going to contribute to the micro collapse of our economy, but the macro collapse as well. And it's going to mean that you don't have the money to pay your bills anymore. So you have to be very thoughtful with small purchases and big purchases. You don't want to be flexing right now, right? You don't want to be overspending on Starbucks coffee because you need to save as much as you can and cut back your spending because nobody knows what is coming next. You have to put your finances first if you want to succeed. The second thing you need to do, even though it's counterintuitive, is to continue to invest as much as you can afford to lose. I say that because you don't want to overinvest here. Yes, recessions and depressions make millionaires because people with the right mindset see an opportunity to take a lot of investments, whether it's real estate or commodities or stocks, at a discount. You can invest in a lot of these assets when the markets are coming down and when they're at their lowest point. The one caveat here that's kind of a good thing is this could be the next Great Depression or the next Great Recession, right? That implies that we have been through this before and investors and businesses have made it through this before. So if you can continue to invest, you could end up a whole lot more financially better off in the future, and you can have a better chance of preventing your finances from collapsing again. And finally, you want to continue to learn and stay involved. You don't want to shut this stuff out. You don't want to turn these things off because you want to keep up with what's going on so you can make the best decisions with your money. Understanding how things work is sort of the gateway for your mindset and for your wealth. If you know how the system works, you can potentially start benefiting from it. And all of that is going to come through with an education, right? You have to stay on top of what is happening. You have to learn why the Federal Reserve has inflation, why these economies across the planet matter to us here at home, and vice versa. It's important to mention that everything is connected, and I try to talk about that as much as possible on this channel, that one small domino falling somewhere far across the world could actually mean that bigger dominoes start to fall too, and that could affect us. So you have to stay on top of that and start preparing for it and see it ahead of time. You cannot prepare for everything because nobody knows what exactly is coming next, but you have to try to be prepared against what you can see right now. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.